Hi, I'm Phil Grande at philsgang.com. Welcome to my YouTube channel. And during this program, anytime that you want to hit subscribe, like, and share, that would help me out, and I really appreciate it. Okay, so I showed you my little divergence chart, or I call my trend crash chart. What does that mean? Well, first of all, the stock market has been going up after we had the crash from February 2020 to March 2020. They say it was up because of a pandemic. It wasn't, because yields were too high. We record every week and search every week for anything that's going to pull this market down. And here they are: record high deficits, record high budget deficits, record high national debt, record high inflation, record high yields, on and on and on and on. We're going to add one more today. It's going to be the real estate market. This no one's talking about. Now, let me explain what I mean by that. This is very serious. Okay, so what we're talking about is this. If you remember, in 2008, if you look back here, in 2008, let me get my little pointer here, when the market crashed, by 2008, how they stop it from crashing? They did what they call QE. They printed money. They printed $1 trillion, then they printed $650 billion, then $400 billion, and $1 trillion. And why did they do that? To keep yields down, to prop up the big tech stocks. Remember how this whole market has been financially engineered since 2008. And how did they do that? Well, there's things that move inflation. And what that is supply chain problems. Oil prices going higher, increased money supply. That's all inflationary, very bad. But what's been driving the market to prop the whole market up has been big tech stocks. So how do you get big tech stocks to go up? You got to get those yields to go down. Now remember, we're talking about, are they going to taper the $120 billion a month? No. Because remember, when inflation rises, the only way they get it under control is by using that $120 billion to buy 10-year treasuries to drop those yields. See right here? See how they dropped? Dropped. And when the yields drop, the big tech stocks go up and prop the market up. So the whole idea is to make sure the big tech stocks are always going up, propping up the market. They've been doing that since 2008 by keeping the yields down. And they keep yields down by having that $120 billion a month supply of money to buy treasuries to drop it down. But now there's a problem going on, as I told you, that real estate market. And I think you're going to see that enter a crash. What do I mean by that? I think it's going to facilitate a crash in the market, or at least a correction, another correction of maybe 30% or more. Because again, once we finished with the QE, and then remember, we stopped with QE around 2013, but we found out, the market was crashing. The market wasn't holding up. So they said, we got to do more QE. Then they said, well, Remember, Trump got into the market got into the race about 2015, and then remember he was going to get rid of all the QE. I mean, he's going to get rid of health care, and he's going to get rid of regulations, and people were all excited, and the stock market was moving up without any financial engineering. But something happened there in that point. From the time he entered the market, okay, and from the time Trump entered the stock market, which was around late 2004, and entered a race since late 2014 to 2015. Okay, the market started to climb because everybody was excited what he's going to do. But guess what else was climbing? Yields. Look at that. So the yields were climbing, and the yields are like poison to big tech stocks. It wasn't 125 basis points. It was almost 160 basis points. That is what dropped the market. That's what took the market down, is yields were too high. And when yields are high, big tech stocks sink. And as the big tech stocks took this market down, but they told us was because of the pandemic, which was a bold-faced lie. If the pandemic never hit us, we would have gone down 31% anyways, because the yields were too high and big tech stocks wouldn't have been there holding up the market. That's why we went down. So what they did is they immediately started again with that $120 billion a month, buying 10-year treasury yields to drop the 125 basis points, to drop it to 80 basis points. So now yields, interest rates, long-term, were dropping to 80 basis points. That was fantastic for big tech stocks. So big tech stocks, just like you're propping the market up here, through QE. Now they're propping up the market here through low yields. So now we go back into September. We had a little correction back here in September, remember? Why? Because yields were too high. Yields were back up to about 125 basis points. So that's why they came in again and they said, okay, let's start dropping yields to get big tech stocks to start moving up to prop the market up again. That's where we are right now. But the problem is we're at 170 basis points. That's too high. So that means they are walking away from big tech stocks right now. And that couldn't be a worse time because right over here, this is the real problem. If they close the economies down in Europe, half or all, and oil starts dropping, that's a big problem. Because what happens when oil around the world drops? Housing prices drop around the world. That's right. Think about that. Oil identifies the strength of your economy and your global economy. That means when oil prices are high, just like when rates are high, it tells you got a booming economy. Everything's in demand. So when you got oil that's booming, okay, and prices are going up, that means, boy, your economy's doing great. Everybody needs oil. Manufacturing, oil for lipstick, oil for fish, oil for everything. Well, guess what's happened? It's not working anymore. So oil, because they closed Austria down, they're closing parts of Germany down. Now they said in the next 2-3 weeks they think they'll have full closure of Europe. If that happens, oil will drop, and it takes home prices down. It takes the confidence out from everybody, and once people start losing the value of their home, they lose confidence. They stop buying stocks. They run to bonds, and the market crashes. So even if they can get yields back down to, let's say, 140, 150 basis points, by once again using that 120, that's why it's a joke. They're never going to take that 120 billion and ever drop that down any significant. They're not going to taper that 120 billion significantly. They need that to keep doing what? Keep driving yields down, to keep pushing up tech stocks. That's what's been driving this whole market since 2008. Every rally is tech stocks. If you take that 120 billion away, and whatever we have for it causes inflation, whether it's a supply chain, oil prices going up, increased money supply, there's no way to get the yields back down, to get big tech stocks up, to hold the market up. So what we're going to see in the next 3-4 weeks, right here, let's watch our oil. And let's watch our 170 basis points. Let's see if it's going to keep going up beyond that, or can they get those yields back down to keep propping up the market with tech stocks. Also, what's key, the housing market. So think of over here. Here's the oil market. If oil goes down, it's going to take the housing market down and the economy with it, no matter what the yields are over here. This is how serious this is. And that's why it's on my ladder this week. That's why I added it to my ladder. That's how serious it is. Because that, even if yields went back to 150 basis points, 125 basis points, it's not going to be enough to hold the market up. So that's why I'm adding real estate to this list. And I think it's the real estate will take us down probably in February, March. Because that's based on if oil keeps driving, because Europe is closing down their economy, okay? This is very interesting, but here's what you don't have to worry about as a gang member. You don't care. You could give a damn less. Because if the economy closes, stock prices go down, we're going to make money. It doesn't close, yields go down, big tech goes up, we're going to make money. We're going to make money either with a good economy, or we're going to make money shorting with a bad economy. Don't matter to us. That's why, please, for 10 days, if you're not a gang member, will you at least try it for 10 days free, so that at least for the first time in your life, you can understand shorting and understand how easy it is, okay? Because that's what will save you. See you on the charts.